there's very little tax collection or tax rates. And I think the government has looked at all the tax heads, and maybe the only tax head that they can think of is excise duty on mobile lending or on mobile loans, so to speak, because that's a new area in that space.
Yes.
Remember when digital service tax was introduced previously, there was a bit of labor here and there, but again it was implemented. And I think this is an area that government is looking at to show up our revenues. I remember government has been struggling to pay its month-on-month debt installments, and that is an area that government must be able to raise revenue to be able to meet those obligations. Our current monthly debt obligation comes to around 114 billion Kenya shillings, which is quite high considering that what we collect is around 139 billion month on month. So this comes at a time when government has very little room to maneuver its revenue, and I think it's something that they're very keen to implement. If it's not implemented now, then maybe in the next quarter it could be implemented. But what I must say is that when governments do that, there is something called crowding out the private sector.
Yes.
Because when you make credit so expensive to the private sector, then they cannot be able to borrow from commercial banks or from the digital lenders to be able to do their small businesses. So essentially, what you're doing is you are killing the cow that gives you milk, so to speak, because they're the same people. You expect to pay VAT, you expect to pay income tax, you expect to pay the other taxes. When you block their revenue, or when you block their capital stream, then you're essentially killing them. So it is a tax that I know will come to pass, but it's not a tax that I think will show economic growth in our current context.
Yes.
And maybe the next government, I want to propose that should have a rethink on some of these taxes. You want to make credits cheap so that private sector can be able to borrow.
Yes.
And spur economic growth. But when you make credit so expensive, then essentially you're telling the private sector not to borrow, so that it's only government that can borrow from the commercial banks or from the private lenders. That is a catch-22 for government, but I know they're keen to implement that tax, as it were.
This conversation now comes at a time when inflation now, we do know, has jumped to 7.1%. That triggered the Central Bank of Kenya to increase the CBR by 50 basis points to 7.5% for the very first time in like 2 years, which essentially means more expensive loans again on top of this excise duty. If you were part of that finance committee that is going now to sit on this bill and then give delegations to the National House, would you pass it, going by the fact that indeed what we expect now in the short term at least is a demand for the loans because of the 50% because of the 50 basis points has been increased? Would you recommend it?
I wouldn't recommend it, Elijah. If you look at the economic situation currently,
yes,
not only in Kenya but even in the wider market. If you look at the US, for example, the inflation rates are going as high as 8.3%, the highest for quite some time now. And we are looking at very many economies not performing. In fact, China recorded the least performance in the last 10 years at 2.1%. So these are time to look at more economic stimulus packages other
yes,
than taxation. So if I were sitting at Treasury, Elijah, I would want to look at ways of taming inflation, as it were. 7.1% is quite high given our context.
yes.
Though most of it is not our making, because a lot of it is imported inflation. For example, our oil prices have jumped, I think, almost 20% between Q3 of last year and today. The same to most manufactured goods, because of one, the disruptions in the supply chains between 2020 to 2021, and also again with the war in Ukraine and Russia, that has really blockaded the supply from that line. So I think treasuries should look at the longer term and see how we can insulate our economy from these external shockers, but not to come in and try to tax,
yes,
or increase the local taxes that will block or that will puncture the current economic growth that we are having. I think maybe going forward, Elijah, government should start looking at more of spurring our agricultural production, so that at least we can be able to self-sustain in whatever we can get locally, rather than import. Because one of the issues that I think we've had is that our FX reserves, Elijah, are getting down. I think you saw that with palm oil. And if we are to continue that direction, Elijah, then we might have an economic situation that is similar to what countries like Zimbabwe is experiencing currently, which might be a very unfortunate situation for an economy like ours.
Fantastic. At this point, I want to introduce the conversation. Stella Swaki, who's an investment analyst at Cyton Investment. Stella, let me just put you into the conversation this morning. This 20% excise duty on our digital loans, what do you think really informs this push at a time when we do know that the CBR has also been increased by 50 basis points to 7.5%? Do you think it's important that we have discussion, or this is something that needs to be quashed?
Okay, thank you, Simba, for having me this morning. So, in my view, one of the sectors that is mostly affected by such proposals is the private sector. And after the MPC met on Monday, the governor of the central bank announced that the private sector credit growth had grown significantly over the month of April by around 11.5%. And this is a very high figure in comparison to the other times. So we saw, like, for example, last year, for the same period, the growth was at 6.8%. So it's almost double the figure. So seeing the government proposing to increase taxes on digital lenders or on digital lending platforms, given that this is a very important platform for most people in the private sector, we are expecting to see the private sector credit growth go down. But then on the upper hand, we see the government trying to raise revenues, given that we saw the budget increase to 3.3 trillion, and there's always a deficit in our country, given that we always have higher expenditures in comparison to the revenues that we're able to collect. So having to raise the excise duty is seen as a move by the government to increase the revenues that is expected to collect, because digital lending has expanded so much. It has gained traction to many people in the private sector. So I think this is it's an avenue that the government is gaining traction towards, whereby they think they will get much revenue from. But then on the lower end, again, we will see the private sector, or people in the private sector, decline in getting loans from these digital lenders. So again, there will be less money in the economy or in the private sector. And we have seen, for example, from the numbers by the PMI that measures the business environment, the growth or the deterioration, it deteriorated last month. And for this month, again, it has deteriorated to, I think, 48.1 or something. So we are seeing a deterioration in the business environment, yet the government is trying to add revenues through taxing the panels or the avenues where this private sector people are getting money from. So again, the CBK had issued a directive, was given the power to license or to regulate these digital lenders. So in my opinion, I would expect the interest rates to go down, because the digital lenders now are being regulated. So they will be like other lending platforms, for example, banks, which are regulated and they issue loans through collateral or something, so the interest rate is expected to go down. But knowing Kenya and our digital lenders, we do not expect to see much decline.
In terms of interest rates, isn't it?
True. So I think this will have a negative effect in the short term before people now get used to the interest rate, given that we have seen digital lenders like Branch, the one that is so common in many people. So in their website, they say the loans, the interest rates range from 22% to 229%. So this is quite a very wide range. So you can imagine, depending on the loan portfolio of the borrower, so you can imagine the person getting a loan on the higher end with interest rates on the higher end. 229 is quite a large sum of money when you're paying for interest. So it's like we are doing business to pay interest.
Yes.
Yeah, so in my opinion, this might have a negative effect on the private
Just 15
sector.
seconds, Stella, just before we move into the next part of this conversation this morning. So I know Parliament is going to discuss this. The Finance Committee is actually looking into this. Now, going by what you've just mentioned, the 7.5 CBR rendering late right now, and then this 20% excise duty, we saw exactly what happened to the government when they increased tax on airtime. They missed it by a big margin. Do you think this is give or take, or are they sure that this is an avenue then that they can actually get this money from?
Currently, with the current economic environment,
Yes.
Kenyans are like desperate to say for money because there's less money in the economy.
Yes.
So we might see Kenyans going for this interest, for these loans, even with the high interest rates. Because even in the past, we have seen them going for them at these high rates as opposed to banks because of the procedures, the collateral. So when I just download the branch app, I'll get a loan immediately wherever I am.
Yes.
So the convenience of these digital lending apps might see Kenyans still continue to borrow because it's like we just want money. We don't care about the interest. so people might continue getting these loans and the government might get what they want, that is the revenue from excess duty on digital lending. So again, we are not sure that they will achieve 100% of what they are aiming at.
Yes.
But for sure, there will be an increase in revenue.
Pretty much expensive loans, should we call it. Now let's move on to the next one. Now the Central Bank of Kenya has been put on the spot yet again, days after defending allegations of dollar shortage in the country after Pani Oil, the manufacturer of fresh fry, salad and fry mate cooking oils, temporarily shut down in what they blamed on a dollar shortage in the country. The manufacturer, while closing the company, indicated that they were only processing half of the dollar orders meant for payment of suppliers of crude palm oil imports from Malaysia amid stiff global competition, a factor that made their operations, according to them, difficult. Last week, during the monetary policy briefing, the Central Bank of Kenya Governor Dr. Patrick Njoroge played down claims from Kenya Association of Manufacturers that the country was going through a biting dollar shortage. Now, this story is sort of like a continuation of exactly what we've played. We call it expensive loans. That's the story that we're playing. But indeed, what we're addressing there is the dollar shortage. Let's take a look at that. Central Bank of Kenya is now calling its latest move to raise the benchmark lending rate to 7.5% from what has been a well-calculated and intended 7% for more than a year, a necessary move to curb the rising inflation in the country. As Kenyans now stare at expensive loans, CBK indicates rising interest rates is not just a local spectacle.
If we allowed inflation to just get into the economy, right? Then, in some sense, it would be significant. It would be damaging significantly, right? So my point here is that we don't want to go there, and that's why the MPC took that decision and will maintain a watchful eye on developments.
According to the banking industry regulator, the Russia-Ukraine crisis is to blame for the global inflation, which pushed local inflation to the limits, with prices of basic imports like wheat and oil largely to blame. So what is the expected outcome?
This will have an effect of constraining aggregate demand and also indicate the direction. In a sense, is a very strong signal as to where the central bank wants the economy to go.
With the Kenyan shilling exchange rate against the dollar also spiraling out of control in the recent past, touching 117 shillings today, the governor has expressed confidence in their forest reserves capacity, saying they have a plan.
So we are not worried about that. We do project these things way in advance. So we have a projection running 2 years from now, and actually can go even further if we wanted to. But in a sense, for robust planning, we have at least a 2-year horizon, and we are quite comfortable about the levels that that we will have on a monthly basis, on a weekly basis, and even on a daily basis.
He has also disputed claims by the Kenya Association of Manufacturers that there is a dollar shortage in the country that are saying their importer businesses affected in the recent past.
What is all this about? You know, it's interesting that some of the people that are writing to us don't even have positions. They are not in the market.
It is tough times ahead for Kenyans as they now look to fight the high cost of living and increased cost of credit for their businesses. Simba, Elijah Charles, Kiage, Look Up TV. George, it's comical indeed when you watch the Central Bank of Kenya Governor Dr. Patrick Njoroge trying to respond to that particular one. Is cognizant of the fact that inflation has jumped to 7.1%, and exactly what they've done, well understood, well elaborated. But when he's asked, the Kenya Association of Manufacturers is saying there is a dollar shortage in the country. He says, ask the pink paper, they're the ones who are running that story. We don't know who that is, Business Daily. And then he says, well, even some of the guys who are writing to us are not even in business. Okay, a couple of days later after that, Pwani Oil, we do know, in a very critical part of business now, they announce, we don't have dollars. I mean, we have to shut down. The latest move they've done is that they're asking local suppliers to pay in dollars. So that the weight is not just for them looking for that dollars, so they're now spreading that way to their suppliers as well. Expected implication, rise in the cost of that product. George, how do you start to examine whether we have a dollar shortage in the country when the authority has said, well, we have a proper import cover, 4 to 5 months. And he said, we're not worried. He's even saying it can go up to 10 months if people want. But then we are sticking within the 4 to 5 months legally. Who's telling the truth?
Elijah, let me put it this way.
Yes.
And let me put it comically this way.
Yes.
When the frog tells you that the crocodile is sick, then you better believe that actually the crocodile is sick because they live in the water, all of them.
Yes, yes.
When KM tells you that there is inadequate dollars in the market, then you better believe them because they're the ones who do the day-to-day trading in the market.
Yes.
And Elijah, from where I sit, I deal with most of these manufacturers quite a lot on a day-to-day basis.
Yes.
And I can confirm to you that dollar shortage in the economy is a reality. How did we reach there? I want to believe Patrick Njoroge when he says that they're in control for the 2 years, because if they're not in control, then it can be very scary. Most of our day-to-day goods that use in the market are imported, and the most important one is fuel that drives our transport sector, our manufacturing sector. You can imagine a situation where we don't have dollars to pay for our imports. That can be a space that we don't want to go into.
Yes.
How have we gotten to that? Elijah, one of our biggest expense in terms of dollar payments is our loan repayments. I told you that we pay around 114 billion monthly in monthly loan repayments, and those loans are dollar denominated. Remember when we took the Eurobond? I think that was in 2019, 2020. And then the Chinese loans, most of those facilities are dollar denominated, and the contracts are such that you must make monthly payments as and when they fall due. Therefore, the government is so constrained as to get enough dollars in the market to be able to pay for these recurring obligations. Number two, our biggest FX earners, Elijah, is one. The biggest was tourism, and then we have tea, and then we have coffee. Tourism didn't perform in 2020, 2021 by a very large margin. In fact, tourism was one of the most affected industries in the market.
Yes.
And that explains to you why our dollar inflows went down. Coffee has not been performing for quite some time now. That I think all of us know. If you look at the tea auctions over the last, I think 1 year, it has dropped, and that tells you why government is struggling to get enough dollars to show the market. There's something that government did last year when they borrowed from the IMF. The main purpose of that was to be able to get dollar inflows, to be able to balance our balance of trade.
Yes.
And I think that worked for I think 1 or 2 quarters. But we are back to where we were. That is inadequate dollar inflows to be able to pay our recurring obligations. So as it were, Elijah, our only savior is still Patrick Njoroge and the central bank, because they have to do something. An economy like Kenya cannot afford, even for a single day,
yes,
to say that they don't have dollars in the economy to be able to pay for our imports. Then we would say that we're not taking our position as a leading economy in this region. Elijah, I trade in quite a number of countries in the region, and one of them is South Sudan. In South Sudan, if you want to repatriate even $100,000, then you have to get a lot of approvals around, and that curtails the day-to-day running of business in that economy.
Yes.
We don't want to get to that level where if you are to repatriate, or if you are to send say $1 million to purchase crude oil, then you have to get authorizations from all over. Then it will make our economies slow down, and that, in a sense, will dampen our GDP growth. So I can tell you for sure that we have a crisis in dollar supplies in the economy,
yes,
that is affecting the manufacturing side of our economy. And central bank, and by extension Treasury, must urgently do something to be able to stem that risk in the market if we are to survive in the next 1, 2, or 3 quarters going into 2023.
Yes. Pretty much. Stella, I want you to weigh in on that as well. I mean, we have the authority coming in, speaking publicly, saying 4 to 5 months of import cover, well done, dusted. I don't know where these stories are coming from. In fact, to quote him, he said, go ask them. That's it. That's the Central Bank of Kenya Governor, Dr. Patrick Njoroge, saying, you go ask them. As far as we're concerned, we're good. So where is this disconnect coming from? You hear what George is saying? Well, you got to ask those people who are in that business for you to get the reality in that. But we're seeing the ramifications already. So where's the hold, Stella, in this conversation?
Okay, so Simba, that's why we have the CBK.
Yes.
They have their functions. So they're supposed to ensure that the forex reserves in our country remain convenient, such that, like, we have to learn from countries like Sri Lanka. This is a country that has only 1 month of import cover. So in a month, we don't have dollars, we can't import fuel, and it's a country that imports like everything from food,
yes,
fuel, because it's an island. So we don't want to see ourselves, just like my colleague is saying, we don't want to see ourselves in a situation where we will not be able to import things like fuel,
yes,
things like food. We are also net importers. And historically, we have seen our country in a trade deficit every time. We have never been able to match the imports and the exports.
Yes.
The imports are always higher than the exports. So given that, and again, we have to pay debts every time, because our debt again is going so high. And currently for the financial year, the next financial year 2022-2023, we're supposed to pay like 63.3% of our GDP will go to debt servicing. So the less than 40% is expected to take care of everything else for us as a country, the recurrent expenditure, the development expenditure, and all those things that a country requires.
yes.
So if we are going to again exhaust our reserves, and we are expected to pay our debts, we are expected to import fuel, and we saw the fuel crisis that we had a few months ago that had seen, we were all complaining with cans, jerry cans at stations looking for fuel now and then. So imagine that being the situation forever or for months. So I think I would it's a good thing they are rationing the dollar.
Yes.
It might be a good thing for our economy.
Yes.
Given that they also gave a directive to the commercial banks to ration the dollar exchanges. So we don't want to see ourselves in such a situation like Sri Lanka is in. And these things happen for us to learn. So we have to learn from other countries. We can't just go there and we've seen what is happening in such a country.
Yes.
And again, as you've said, we were given a loan by IMF and it was able to boost our reserves for a quarter or two. So we are also expecting another loan, the one that the IMF and Kenya agreed
Yes.
after the third review.
Yes.
So that one, again, we are expecting it, I think, at the end of this month. So again, we expect that loan to boost the reserves in the coming months, and maybe the situation will ease and maybe we will see again a boost. But as the central bank, we expect it to ensure that we have enough forex reserves, ensure that inflation is maintained at low levels. As he's saying, the CBK is our savior, Patrick Njoroge is our savior. If he doesn't do what he's doing,
Yes.
I don't know where we'll end up.
Pretty much. George, quickly as you respond to this, because the next story is also just touching on that particular area on inflation. I mean, is that what it is? That he knows the loan is coming, so until the loan is here, let's protect the face of the economy. Let's keep on speaking tough because the loan is coming. But on that particular aspect as well, that for this country, for our country, to balance our forex reserves, we are so highly dependent on loans. And at this time, we are paying high interest rates because we don't know what the Fed has done with their loans as well.
I think Elijah, Patrick Njoroge is right to do what he did. He
Defend?
cannot,
even when the situation is really that bad.
Definitely.
Is that what you're supposed to do, George?
If you look at a country like Kenya,
Yes.
let me give you an example of commercial banking.
Yes.
Because I've been in that space.
Yes.
If the CEO was to come up and say they don't have enough money to pay their depositors, the bank will go under that same day.
But what does the CBK have to lose if they say this is the situation?
That is what the Patrick Njoroge is trying to do. He must put on a brave face
Yes.
and tell us that things are good, even if he knows things are not very good.
Yes.
So that at least there is some comfort in the market. That's what he's trying to do.
That's
I know at the back end, he knows that there's something that is cooking
This is a
that is
fire,
likely
isn't it?
that is likely
Yes.
to save the situation.
Yes.
But as it is, you see, the buck stops with him, and therefore he must give us that confidence that as an economy we are still strong. As he goes back to the kitchen and see what he can
Yes.
what he can do.
Yes.
So I think he must move very fast to stem that forex risk as it is.
Yes.
I think it's something that he must do within the next 1 month, if that is to be managed properly. If he doesn't do that, then we'll have a problem with the manufacturing sector. We'll have a problem with our FDIs because
Yes.
FDIs cannot come into the economy where they cannot repatriate dollars. We'll have a problem with even the current investors that we have because they must be paid their dividends in dollars. Companies like Safaricom, Vodacom must be paid their dividends in dollars. So if you're telling them that they don't have dollars in the economy, then you have a big risk in managing this that space. So Patrick Njoroge must put on a brave face and reassure us that actually is doing something about the dollar shortages in the economy.
Put in a face. Is that what it is? All right, now let's move on to the next story that we have for you. Now, days after Kenyans learned the cost of electricity was bound to reduce by a further 15%. Kenya Power is back in the headlines for the wrong reasons. This time, transformer shortage. According to data from the power utility firm, the shortage is so acute that they are unable to replace faulty transformers with new ones, instead opting to repair them. This could increase the already high amount of power interruptions that customers currently face, disrupting both households and business activities. Official data from the Kenya Power shows that a customer average interruption duration index, that is the average duration each customer was off power supply in a month, stands at 4.03 hours. Wow. I want to start with you, Stella. Just quick sentiments on Kenya Power. Now, we do know they don't have the power to purchase and manage power supply in the country. That is on Ketraco. Then what's going on?
So just when we thought electricity prices will go down,
Yes.
there we are. So we had the first cut, and this one really cushioned inflation, given that the fuel, everything was going up.
Yes.
It was the only one thing that was saving us, just to say. But now they are coming with stories, which might be true.
Yes.
But then we have seen people in charge of these things, and they are saying the transformers are faulty because of being mishandled. Like, what are they telling us as Kenyans?
Yes.
You know, because we are expecting them to fulfill their promises. But then we can also never blame them, because the discussion was between the current IPPs and the Kenya Power and also KenGen. But we saw the IPPs refusing to bring their costs down. So maybe before they decided on telling us they will cut costs by 15% or by 30%, then now they are telling us stories. I think they would have first involved everyone that was in the picture. So let's discuss, this is what we want to do. Are you willing to do this? Yes. Are you willing to do this? No. Let's discuss, what do you want? So that you don't give us Kenyans empty promises or tell us you'll reduce the electricity cost by this percentage, then after some time you're telling us you have transformer issues, because by saying that, they mean they are incurring more costs.
That's it.
And by that, they can never decrease the cost of electricity, the cost at which you are buying electricity. So again, I don't know where they were getting revenues to match whatever they cut.
Yes.
Because they didn't cut on expenditure.
Important question, isn't
Yeah.
it?
Yeah, they just cut the
Yes.
cost of electricity,
Yes.
which means they reduced their revenues by 15%. And they wanted to reduce by a further 15%, making it 30%. So 30% of your revenues is a very huge number. And you not being sure of how I will match my expenditure.
Yes.
Or how do I reduce my expenditure to match whatever revenues I've cut, that one will pose a question and will pose problems to you as whoever who is cutting the revenues. So again, when you're increasing, when now them telling us that they have faulty transformers, that they cannot reduce the electricity any further. There are some questions
that we need to ask on that. That's what I want to put to George. George, do you read a certain push and pull now between Kenya Power and KETRACO? Because, you know, when you're told that you have no power to purchase and supply, that is not essentially your work now within your own company, that somebody else from somewhere is coming to do that for you. Is it sabotage that we're saying? Because 4 hours within a month, averagely, for even a business, that's a long period that we're looking at. And that, is it this 15% that is already biting into Kenya Power? Because you walk in and then you say cut it by 15%. How? If some of the contracts that they had on that were even 10, 12 years long, that would actually see Kenya Power keep on getting this infrastructure.
Elijah, there's certain things that happen in the economy that are symptoms of a bigger problem.
Yes.
And one of them is when a utility company like Kenya Power is struggling to do their day-to-day operations. When a company like Kenya is struggling, those are symptoms of a deep problem in the economy.
Yes.
Transformers is what I call consumables for a utility company like KPLC. And I would expect that they have enough in their stores to be able to replace the ones that are faulty within our borders. When KPLC tells you that they don't have transformers to replace the ones that are faulty, then it's a symptom of a bigger problem. Remember, KPLC reported a very big profit last year, last financial year, I think around 2.8 billion, which is quite huge if you look at our context. And therefore, if they're telling that they're struggling with importing some of these things, then maybe it points to two things. One, that maybe the profits are window dressed. They don't have enough cash flows in their coffers. That is one aspect that you want to look at it. Two, that maybe they're affected by the dollar shortages, that they cannot import some of these things into the economy. Therefore, they don't have them. They don't have those items in their stores.
Yes.
Or three, they've just decided to be negligent and not do what they're supposed to do. But the way I look at it is a symptom of a bigger problem within KPLC itself, and even within government. And those are some of the things that I think government must come out very clearly and tell us actually what is this that is ailing them. Remember, Elijah, we had problems with KQ sometimes back, when they were not able to pay their pilots, they were not able to pay their employees, and after a certain time, then they came and told us that actually they are bankrupt or they're insolvent, so to speak.
Yes.
So some of these things we need to have a deeper investigation. That's where now the Auditor General come in to tell us what is actually happening in some of these very important utility companies in our economy,
yes.
So that we know actually what is it that is happening. I want to believe that for KPLC, the demand side is sorted because they're a monopoly. If you're a monopoly in an economy like ours, what you need to do is to generate the supply, and you are sorted on the revenue side, because everybody must get their power from KPLC. If you cannot manage that simple business model, then there's a huge challenge. I want to think, Elijah, and that's just my thinking, that maybe what is happening is that KPLC and by extension KETRACO are not able to import new transformers in the economy because of dollar shortages in the economy. And therefore it goes back to what Patrick was trying to say, that we have enough dollars. Actually, we don't have enough dollars to be able to cover our imports as and when they fall due. So I want to treat this as a symptom of a bigger problem in the economy. And how to do this, Elijah, is through what we call fiscal consolidation. That is the only area that Treasury must look into, so that we can look at our total monthly import demands and be able to allocate it across the various economic sectors, so that we don't suffer some of these things. Next time, KPLC they don't have enough fuel to power their operations around, and you have blackouts all over the country. What would you do, Elijah?
Pretty much. All right, let's jump into the last conversation this morning. Now, Kenya's inflation for the month of May shot up to 7.1% from 6.47% in April on the back of high cost of fuel and food items in the country. Now, the Central Bank of Kenya Governor Dr. Patrick Njoroge, during his Monetary Policy Committee briefing, indicated that they had been forced to increase the benchmark lending rate to counter the inflation. In a huge contrast, though, to Kenya, first world economies like United States of America are battling the highest inflation numbers in decades. United States inflation for the month of May marks at 8.3% in what is a 40-year high figure. Germany's inflation jumped to 7.9%, with this trend experienced in other European markets as well. Now, May saw China's inflation jump by 2.1% as well on the back of high fuel prices. Now, with this huge economy struggling with inflation on the back of disruptions occasioned by the Russia-Ukraine crisis, how? And that's the question we're asking this morning. Has Kenya managed to keep its inflation in check? Let's see what you're saying on the cost of food in May. Even as Uhuru Kenyatta lauded his government for all his achievements since he took over the reign in 2013, 10 years of rule, majority of Kenyans have expressed their dissatisfaction regarding his strength in taming the cost of living. Majority feel the cost of living has not been adequately addressed in the country. For instance, the month of May has seen inflation jump to 7.1% from 6.47% in April as a result of the high food prices, which Uhuru Kenyatta had promised to address when he took over in 2013. With the food inflation being the biggest contributor to the 7.1% overall inflation in the month of May, we arrive at a food market to investigate why food prices have shot up.
Juu kama walo jana tulikuwa tunanunua kwa kagunia kalikuwa kanatoka 1000. Saa hii kanatoka 4. But last month kalikuwa 48 na 45. So naweza sema kwa biashara sisi kama wauzaji tunafinyiriwa sana juu hatuwezi tukaelewa ni nini inaendelea.
Tomatoes now we are buying with now per crate tunanunua na 2500. Last year you used to buy with 1200. You see now it have already increased. So life is very expensive. Hakuna uhuru ata. Juu vile maisha iko hakuna uhuru haki.
Sasa kama hii sukuma nauza 10 bob, nilikuwa nauza 5. Sasa inabidi niuze 10 kwa venye nimepandishiwa na wakulima. Hali ya maisha sasa hivi ni ngumu kabisa. Hatuwezi sema ni mzuri. Juu kila kitu iko na bei ya juu.
With the businesses feeling the brunt of the high inflation, consumers alike are having to dig deeper into their pockets to get through the day, with some lamenting about the unsustainable pace at which the cost of essential commodities are rising.
About a year ago, 2 years ago, I will do this shopping for around 800, 750 shillings, but these items have more than doubled. It's a week's worth of shopping and for groceries, but nowadays it's quite hard. It's quite tough, but what do we do?
Hii chakula nimeinunua shilingi 100. Hii chakula nilikuwa nainunua shilingi 50. Maisha imepanda, vitu zimekuwa bei kali, hata mwenye kupika chakula mpaka apandishe chakula yake ili aweze kulipa gharama.
Nimenunua pineapple, nyanya, kitunguu, nimetumia 1000. Lakini unajua sasa hiyo 1000 kitambo ungenunua vitu mingi. Lakini kwa sasa unanunua vitu vidogo tu, lakini tunang'ang'ana tu na maisha.
Kama rais anafaa aseme watu wote warudi chini.
Hakuna pesa, ukiingia kwa duka pesa yote unaacha huko kwa chakula tu. Bado hatujapata uhuru. Sisi tuko bado under colonization period.
Even as Kenyans celebrate Madaraka Day on this 1st of June 2022, 59 years after we got our independence, it appears that for majority of them, it is not yet uhuru on the cost of living. Simba, Elijah Charles Kiage, Look Up TV. Stella, so inflation, 7.1%, fine, we do agree. But when you go back to the market, if you look at the notes for inflation, specific notes for that inflation, they're saying, number one, cost of food, shot up, cost of fuel, shot up. Essentially, when you look at the cost of transportation, shot up as well. Then you say, fine, maybe it's 7.1%. Then you go to the people who are giving you these loans to run your country. Number one, the Fed has increased interest rates. If you look at Europe right now, inflation is at its worst. USA, 8.3%, Germany, 7.9%, China's CPI shot up by 2.1%, and they're saying it's because of high cost of fuel and the coronavirus pandemic. But when you come back to the country, you're told, even as consumers are saying, it's double the price in just a short period, which is essentially runaway inflation that you can't control. It is still 7.1%, still within the anchor region. Who's saying the truth? Are we at 7.1%?
So, first of all,
yes,
we are not colonized.
Would you say that though?
We have
we're waiting on a loan from IMF to stabilize our forex reserves. If they don't give it to us,
an economy can't run fully without debt.
Yes.
Yeah, we need such things. We need help. and it's okay. The government is borrowing from multilateral loans,
yes,
loans with a lower interest rate rather
yes,
than going to bilateral loans. So it's true, I agree with the people in the market. When you go to the market, I was also buying biscuits, the Novita, the 5 shillings Novita.
Yes.
But when I was buying from a hawker, he told me nowadays there's no such price. It's 3 for 20 shillings.
Yes.
So I was actually shocked because I didn't expect that for such small commodities. But then, again, even if you go into a supermarket, as they're just saying, the kind of things we were buying with the money that you can go with now, you are not getting the value for your money right now. We cannot blame the government because inflation everywhere is going up.
Yes.
And I'm focusing on Sri Lanka because Sri Lanka is currently in an economic crisis.
Yes.
So for countries like Sri Lanka, the inflation rate is at 39.1%. So again, when we come back to our country, we have an agreement with IMF. Our inflation rate, when our inflation rate goes beyond 7.5 or below 2.5%, there's no longer an agreement.
Yes.
So I don't want to say that the numbers are not true.
Yes.
But inflation has gone up.
Yes.
But again...
But imagine, though, when you listen to the doubling of those commodities. I mean, we spoke to the traders. When they're saying that food inflation, Joe, let me jump to you on that as well. Before I get back to Stella, you're going to tell me that point. I mean, to investigate is that you got to go to the people. They're saying the cost of commodities just a month ago, 2 months, 3 months ago, in January up to now, is more than doubled in some quarters. And when the CBK, when the CBK is telling us, well, it's 7.1% due to high cost of food prices, could you factor that in? Are we at 7.1% when the people who are sponsoring our economy are saying, well, we are doing at 8.3, 7.9, 7.8. It's a third world economy. That's how we start to look at it. We are a third world economy. What is this making our inflation not shoot at the roof?
I think Elijah, you must give it to central bank and treasury that they've been able to manage our inflation rates for quite some time now.
Yes.
In fact, for a better part of this the last 5 years, our inflation has been oscillating between 4.5 to 5%, which is a good range to be in. Over the last, I think, 2 quarters, our inflation have gone to 7.1. It's likely to go even higher than that in the next 1 or 2 quarters going into 2023. But Elijah, that is something that is I want to call more of the world economy that has suffered a lot of economic shocks.
Yes.
Remember, we had the corona pandemic between 2020 and 2021, which affect almost all economies across the world. And then, as we are trying to get out of it, Elijah, then Putin, in his wisdom, decided to invade Ukraine,
yes,
which was a very bad idea from my perspective, because most of the economies are just trying to recover from what they lost in 2021, and then this happened. Remember, during the corona pandemic, there were a lot of supply chain disruptions,
yes,
and we were not able to get most of our products from our supply areas. And if they were coming here, then the logistics involved were quite huge, and therefore that meant that the landing costs were quite high. And as soon as we were trying to get out of that, and then this happens. And when this happened, we had the imported oil inflation, that is the oil prices.
Yes.
I think last year we were doing petrol prices around 107, 108, thereabout. Now we're doing at 150. That is almost more than 30% increase in price of fuel. And fuel affects all the other commodities in the market. That's why you find even agricultural goods that produce locally, the price have gone up because there is the cost of fertilizer. You know, fertilizer mostly is done in Russia.
Yes.
So the cost of fertilizer has gone up. The cost of transport has gone up. The cost of so many inputs has gone up. That explains why our inflation has risen from 5% that we are reporting late last year to 7.1% this year. I think if you look at it globally, maybe we are going to experience higher inflation rates in the next 2 or 3 quarters,
yes,
depending on how the war in Russia-Ukraine pans out, and then maybe it will start going down. But I foresee a depression in the world economy going into 2023, 2024, because of the shocks that we've had over the last 2 years.
Yes.
Coming back to our local economy, Elijah, I think government must really think through its strategy to be able to cushion local consumers and even local producers, manufacturers, to be able to survive this. We are an agricultural economy, and the weather has favored us for quite some time now. I think the last 1 or 2 years, the weather has been very good to us. If we can focus on that and just try and do a bit of adjustments in our recurrent expenditure,
yes,
then we can be able to survive this season. But if we don't do that, Elijah, then we are in for a very rough ride in the next 1 or 2 years.
Yes.
These things happen, Elijah. There are those times that we have booms. There are those times that we have depressions, and this is the time that we're likely to have a very serious depression in the world.
Yes. All right, Stella, in actually 1 minute, if you can, if we are a net importer economy, when we're given these official numbers by the Central Bank of Kenya, do we say, since we are a net importer economy, if the economies that sponsor our economy then are facing this inflation, then indeed we have to get worse numbers than they are getting then? Is that what it is? Is it a direct correlation, or indeed then you got to look at other factors as well when you're looking at that number?
Yeah, we can look at other factors, but one of the most important factors that we can look at
Yes.
is the subsidy that the government, through the Petroleum Development Fund,
Yes.
has been able to give Kenyans. So this subsidy has cushioned against high prices. And I believe that this is the number one reason that has made our inflation rate remain within this range.
Yes.
So if at all we were paying for fuel at the same price that we are supposed to pay for, because for example, for the fuel prices for April, the period May to June, the subsidy increased. It increased particularly for kerosene and also petrol. But for all of them, there was an increase. We saw a huge increase from the last subsidy that we were given on
Yes.
the April-May fuel figures. So I believe that this is the main reason that our inflation rate remains within the range, and this figure is really in correlation with us being net importers. But then the sustainability of this subsidy is
Yes.
in question, because again the government is struggling with the expenditure right now because many economies do not have money that we can agree, all of us. So the government is also at risk, not at risk, the subsidy is at risk such that it might not be sustainable, and as George is saying, in the next 2 to 3 months,
Yes.
we might see the inflation figures go high if the government will not be able to sustain the subsidy.
Fantastic.
Yeah.
All right, check them online at Lookup TV. That is across all our social media platforms. I am at Kiage Simba. The conversation goes on, and that number, 7.1%. More things coming. Expensive loans, if they pass that bill, that 7.5% CBR is also coming your way. Expensive fuel prices, and there's a chance, as Stella is saying, that subsidy, if they cut it, more from your pocket to run your business and also move around the roads. All right, we take a short break here on the big conversation, but most importantly, the morning drift. Once we come back, more coming your way.
Welcome to Lookup Guest House, Retreat and Prayer Center. When you first come in, we'll be happy to receive you at our reception, then proceed to our cozy and well-equipped accommodation facilities. We aim to provide our guests with a unique, comfortable, and worthwhile experience. Here at Lookup Guest House, we provide our guests with a continuous supply of room amenities. A cool environment for all your retreat activities.
Lookup Guest House, Retreat and Prayer Center. For reservation, contact us on info@lookupguesthouse.org or call us on 0746 788 707.
Yeah.
Are you looking to turn your passion to purpose? Vera Beauty and Fashion College now brings you online classes at the comfort of your home. We are a TVET-approved institution with over 20 years' experience in training competency-based courses in fashion design and creative arts, cosmetology, hairdressing, beauty therapy, interior design in soft furnishings, event decoration and flower arrangement, hospitality and catering, and training of trainers. To enroll, call us today on 0704 577 577 or visit our website at www.verabeautycollege.com. Vera Beauty and Fashion College, a center of excellence.
Help me identify a beautiful womb. I never came across one till I got to Vera.
Yippee! Kamata floating at 349K. Oh yes! For only 349,000 Kenyan shillings, you become a plot owner at the Great Oasis Gardens, Nanyuki. The Great Oasis Gardens Nanyuki is located along the Nanyuki-Rumuruti Road, only 11 minutes from the Cedar Mall and right opposite Mount Kenya Wildlife Estate. This is the best place to establish the getaway home that you have always dreamt about. For every 349,000 that you deposit or pay as installment towards any of Optivent's plot of land, you get 10K cash back instantly. Jaza basi twende Nanyuki. Bigger is indeed better.
Kwa habari kutoka kaunti zote nchini Kenya.
Habari zinazoangazia maswala yanayokugusa moja kwa moja ni habari kutoka mashinani. Tunakujuza kuhusu uchumi.
Hakuna haja ya kupiga kura. Tunapigia viongozi gani? Na sisi tunapata tabu.
Kilimo. Afya.
Sisi kama wahudumu wa afya ikifika saa 6 usiku hatutakuwa kazini.
Uzalishaji na siasa katika kuelimisha na kutoa hamasa ya kipekee.
Tunataka uchumi wa Kenya usaidie mkubwa kwa wadogo.
Ungana nami Lame Kaungo ninapoleta taarifa hizi hapa Look Up TV.
On a new busy morning, start your day with positivity and vibrance. Look Up TV is here.
Shida sio katiba.
With the hottest, insightful, trendy, and entertaining breakfast, drifting you from the normal.
Join me, Anki Doris Mbat, for the morning drift. This is the all-new Look Up TV.
Aki is the one who's been doing this, so I'm going to try step in her shoes. Wow. Welcome back. This is the morning drift. My name is Simba Kiage. We are all the way into the extraordinary, and this morning we don't have an extraordinary gentleman in the studio. Just let me introduce this particular subject, and I'm going to try and do it my way because it's extraordinary. I'm going to let him speak for himself shortly, but conversations on empowering the young women in the country have really taken center stage in Kenya for a long time. You were saying that indeed we made strides, but some sides of the